the back. That's fine.
Okay.
Yeah, maybe.
Good afternoon, everyone, and welcome to the latest in our series of Professional Advisor Working Lunches. I'm Tom Ellis, editor of Professional Advisor, and I'll be your host for today. If you could please mute and turn off your cameras, just so we can make sure the presentation goes smoothly, that'd be fantastic. Oh, I could just hear one person, but that's all right. I'm sure they'll mute quickly. The death of inflation has been widely heralded, and its absence has been one of the predominant drivers of returns since 1981. And some argue its return would maim the traditional balanced portfolio that has served investors so well for a generation. Now, the post-COVID world has ushered in a new era where long-established investing principles could be turned upside down, harming those least able to bear the burden. We're joined today by two expert speakers from our partners, Ruffer, who will discuss how COVID-19 could elicit a crisis in our most popular asset allocation ideas and where to invest to negotiate this turbulent time. Today's speakers are Ruffer's investment director, Alex Lennard, who has worked at Ruffer since 2006 and is also the manager of the Ruffer Total Return International Fund, the overseas version of the firm's core strategy. And Alex will be in conversation with their business development director, Toby Barklam. Now, before we start today's session, I'm just going to briefly run through the obligatory housekeeping notes. As I said before, your microphones and cameras are currently switched off, and we would be most grateful if you'd be kind enough to keep them that way. It would ensure there's no background noise so the speakers can be heard more clearly. To start the session, we'll be running a brief poll, so please do participate, because your responses will influence the presentations you're about to see. There will be time for a Q&A session at the end, so don't worry about that. Do feel free to ask any questions for Alex and Toby using the chat function, which you will find at the bottom of your screen. If you wish to remain anonymous, simply select my name from the drop-down list in the chat box before you type your message. That way only I can see it. I'll endeavour to put all your questions to our speakers at the end of the presentation. I should also inform you that this session is being recorded, and we will send you a link in the recording, of the recording by tomorrow. So do feel free to share this with your colleagues. As usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link to the recording of the session. And now, in traditional CPD style we know all too well, here are today's Leary objectives. As it says on the screen, explain how global governments and central banks responded to the pandemic, put this response in its longer-term historical context, identify the key argument for inflation and deflation after the pandemic has subsided, and finally, identify and explain how this relates to key asset allocation decisions that advisors will have to make in the coming months and years. So that's the housekeeping out of the way. Let's move on to our main event, and let me hand you over to Ruffer's Business Development Director, Toby Barklam. Over to you, Toby.
Thank you, Tom. Thank you very much. So the first thing I wanted to do was to briefly run through what the shape of the next hour from us will take. So Alex will talk for around 15 minutes when I hand over to him. And then we're going to take a pause in the middle of his presentation to have a bit of a conversational interlude. And that's so that we can discuss, Alex and I, one of the more controversial and topical allocations in our portfolio, which is Bitcoin. So if you have specific questions about it, please just type them in the chat, and I will ask them of Alex when we get to that section. Alex will then pick up his presentation for about another 15 minutes, and then finally at the end, or towards the end, we'll hand back over to Tom for a more wide-ranging Q&A. So as a modest encouragement to participation, we will be raffling off a case of very agreeable wine at the end of the session. So if you ask a question in the chat, then your name goes in the hat, so to speak. Well, it actually goes into my trusty bowl. And then Tom will remind me at the end to draw the winner out. So we'll announce it on air, so to speak. We're going to ask you some polling questions to try and discover how people are thinking about asset allocation at the moment. But before I do that, I'd like to preface Alex's talk. So for those of you who know us, and looking at the attendee list, there are a few of you I recognise, you will know what to expect, and hopefully this will be a useful and stimulating update. For those of you who haven't heard much about Ruffer in the past, I'd like you to concentrate on one thing as you listen to Alex, and that is how different this strategy is to many of the alternatives available to you. For those making fund allocations and asset allocation decisions themselves, this is a difficult time. The world is in a period of profound change, and this is affecting the correlation of assets and how traditional portfolios work. Many investors are scouring the landscape of investable options, looking for more believable diversifiers, and they aren't finding many options. I'd like you to listen to us today in that light. We think Ruffer's strategy is something that can deliver positive risk return characteristics and true diversification to your portfolios in even the most dramatic periods of change. So we'd like to hear from you. We'd like to hear how you're thinking about asset allocation at the moment. And so shortly, we're going to have some questions pop up on the screen, 4 questions for you to answer. Here they go. So I'm going to give you a moment to take some time and answer those. And then we'll show you the answers and briefly summarize them. We'll give it another sort of 15, 20 seconds or so for you to contribute. Right. Well, if we can pull up the answers that we have thus far. So running through it, do you have confidence in a 60-40 asset allocation? That surprises me, actually, that the majority say no. And I think it is instructive of the slightly invidious position that you are as asset allocators, you're in as asset allocators and advisors, that a higher proportion have low confidence in it than more people are using it than have confidence in it, if that makes sense. Question 3, what alternatives you've considered? I think very interesting that infrastructure and absolute return funds are high up there. And finally, a slightly left field question, are there too many or too few ESG and sustainable fund options available to you? I didn't know whether you'd be a cynical audience or not. You are clearly not a cynical audience, and there are too few options for you. So thank you very much for contributing there. We'll send the results of those polling questions round to you, I think, when we follow up. And that just really leads me to hand over to Alex for our featured presentation. So Alex, over to you.
Great. Well, thank you, Toby, very much for introducing me. Just before I kick off and talk about the meat of the presentation, why do we feel that we're qualified to talk about protecting clients' capital through a period of regime shift? This is Ruffer's long-term performance chart, and what you can see is that we've been very successfully able to protect our clients' capital during points of stress over the 3 significant market shocks we've experienced in our history. Now, as I'll come on and talk about, whilst this has encompassed different market regimes, we do think it has encompassed a single economic and investment regime, and one that we think is potentially coming to an end. So Warren's discussing why we think it's important to ask the questions we're asking today. And just very quickly, and I'll come back to why this is our current asset allocation and why these are the assets that we own later. In essence, the Ruffer portfolio currently is effectively made up of 3 core pillars. We have an exposure to global equities, predominantly more economically sensitive cyclical names, to capture any further nominal GDP recovery we see later this year. We have an allocation to alternatives and unconventional protections, which we think will be necessary to protect against deflationary shocks. And then what I'll come on and talk about, the biggest allocation of our portfolio is really to protect against what we see as the threat to the existing regime and potentially the arbiter of the next regime, which is a move to a much higher inflationary world, and one that we think has the potential to, as the title says, blow a hole in many of the asset allocation rules that we've all grown up with. But now less about Ruffer and more onto the meat of the presentation. And I thought it worth starting with this screenshot from CNBC, which in itself is a bit of a caricature. So this is Jim Cramer, who is a loudmouth investment commentator in the United States. But I think what the key aspect of this, and it's a screenshot from April of last year, that shows that at the same time that US equity markets had their best week for nearly a century, you also saw 16 million Americans had lost their jobs. Now, 10 months into recovery, a lot of that is still true. Financial markets are still at all-time highs, whereas the real economy is only just starting to see signs of a recovery. Now, this creates an intrinsically fragile economic, but also political environment. And we think that's pretty important in terms of ushering in the new regime. But before we talk about what we think of as next, how have we ended up where we are today? Now, as most of you will be probably able to tell, I have only been investing during a single market regime. And we would argue that actually pretty much everyone in the asset allocation world has only known a single investment regime. Now, that was first brought about by this gentleman on the screen. Now, for those of you who don't know who this is Paul Volcker. Paul Volcker was chairman of the Federal Reserve in the late 1970s through the 80s. Now, Paul Volcker, when he came to the Fed, effectively ended the last regime, which was an inflation regime. And his banner for his time at the Fed was, I'm going to get inflation under control, unemployment be damned. Now remember that, because that's quite an important sidebar for where we are today. Now, Paul Volcker was very successful at ending the inflationary regime we'd seen through the late 60s and 1970s, but he didn't act alone. He was given a huge amount of support by the external dynamics at play in the world. You saw the collapse of the Berlin Wall and the collapse of the USSR, which saw a huge swathe of population enter the Western working environment. That was further catalyzed by China joining the World Trade Organization, again, adding another deflationary element to the world. And more recently, we've seen the huge technology revolution here represented by the Google logo. But in essence, what you've seen is a single period that has been characterized by uniquely disinflationary conditions. Now, this has been extremely powerful for those owning the balanced portfolio, traditionally the 60-40 portfolio of equities and bonds. Now, why has that been so effective? Really, since the beginning of the 1990s, because of that deflationary backdrop, bonds and equities have been negatively correlated. So whenever you've seen an economic shock, you've seen interest rates cut significantly to try and withstand the deflationary pressures and try and generate enough economic growth. Now, this has meant you've had a unique period, really, as far as we're concerned, looking back over 200 years, where bonds and equities have been negatively correlated. Now, what that means is whilst deflation has persisted, your balanced portfolio has been absolutely optimal. Whereas if you look further back in time, that's far from the truth. But if you take as written, what we've experienced for the last 40 years has been unique, and one that has seen the balanced portfolio be uniquely beneficial for clients. Now, actually, it's quite a narrow balanced portfolio, and specifically one focused around the United States, which is perhaps not surprising, given that they are the most omnipotent central bank in the world and have the largest swathe of technology revolution. But what you can see is that over the last 20 years, equities and bonds have both delivered 8% per annum, and importantly, been negatively correlated at points of stress. Now, just to give an indication as to how unusual this is, the policies that we've seen have brought a significant amount of future prosperity forward. Usually, you would the historical average return on equities is around 6%, and the historical average return on bonds is about 2.5% in real terms. So the US balanced portfolio has been uniquely good and has far and exceeded long-term expectations of either asset class. The other point to note is that any active decision to step away from the United States has been a bad decision. So any allocations made away from the United States has not been enhancing for shareholder or investor returns, as the MSCI World ex the United States has essentially made no money for nearly 25 years. Now, just unpicking some of those disinflationary forces, here is an illustration of Moore's law, which just shows the disinflationary power of technology. Here we can see what a supercomputer looked like in 1956 and the equivalent or far more powerful technology in 2020 today. So it's unequivocal, technology has been deeply disinflationary for the world. I think one place that I would pause is, can we expect the same technological dividend over the next 50 years? Now, my argument here would be probably not. And this just looks at the quality adjusted price for computer sold at $100 since 1989. And what you can see is, yes, there was a very sharp fall in effectively the price of that for the first half of this chart, but really we've been flatlining since. So can we expect the same disinflationary support from technology we've had for the last few decades? And similarly, we don't feel that you're going to get the same dividend from globalization that you've seen. Now, this rather pompous title is something I borrowed from our chief economist. Now, what does he mean by disparate confounding dynamics? Lots of things happen to occur at the same time, as if by coincidence. And what I illustrated in the first chart was that we've had a lot of disinflationary forces take place at the same time. Well, right now, you might just be starting to see a number of those disinflationary forces go in reverse. And this just looks at the price of durable goods, which unequivocally have been deflationary since China devalued their currency and entered the WTO. But even prior to COVID, you were starting to see goods price inflation around the world. So the coincident deflationary forces may all be starting to come to an end at the same time. The difficulty is that because the disinflationary forces have been so great, the authorities around the world have had to effectively bring forward any future prosperity. Now, that has been reflected in asset markets rather than nominal GDP. And this is perhaps illustrated by the caricature I showed at the beginning, but what you can see is the disparity between the wealth of households, so think of that as the total assets in the economy, and is now far greater than the overall productive capacity of the economy. And given that the trick for policymakers over the last 2 decades has been to inflate asset prices to support growth, is that going to be possible going forward? But I'll pause there, having done the retrospective, and I'll come back to talk about what that means going forward shortly.
Alex, thank you very much. So what we're going to do now is move on to the topic of Bitcoin to address it directly, because I think while it is a small part of our portfolio, it is something that has garnered quite a lot of attention, and it feels like it would be odd not to address it directly. I think the caveat I'd give to the discussion would be exactly that. It is a small part of the portfolio, but also that we have not become Bitcoin evangelists, and we do see real risks in it as an asset class, which I'm sure Alex will elucidate on. Now, we've got a decent number of questions in the chat about Bitcoin, which I will come to in a second. But what I'd like, Alex, if you would first, just sort of briefly outline, why did we buy Bitcoin?
So I think, as I hinted at when I was looking at our asset allocation, we've had a long-held view that the eventual consequence of all of the debt built up over the last 50 years will be inflationary. And particularly a prolonged period of financial repression, whereby interest rates are held below the prevailing rate of inflation, will ultimately lead to a degree of disgust with fiat currency and a slightly more inflationary environment. Now, what we've seen post-COVID is that that dynamic has probably been accelerated, and actually you've also seen an acceleration in some of the technological trends that we've seen. So a core asset of our portfolios has been to try and protect against that inflationary world, and one where there is absence of hard assets. And gold and inflation-linked bonds have been part of that. And we think Bitcoin, given its finite nature, has similar characteristics to gold. So we think in a world where people are increasingly showing disgust with fiat currency, we think Bitcoin has a role to play as a potential hard asset.
Very good. So that's the in the jargon, the sort of store of value argument for the case for Bitcoin. Is that right?
Correct. Yes. Store of value plus, I think what you're seeing is an increased wave of institutional adoption. People who are seeing this as a potential asset class within their portfolios. And I think that, sorry, Toby, you go.
Sorry, I was just going to, because it speaks to that point. Martin McCudden asks sort of what would stop the rise of Bitcoin? You know, what's almost the counter argument here? And he suggests two, one of them being regulation, and one of them being governments and central banks coming up with their own versions of cryptocurrencies.
So I think on the latter, I think it's inevitable that governments will come up with their own versions of cryptocurrencies. Indeed, the Chinese are quite far advanced in looking at the digital renminbi and actually using it to provide some of the stimulus into the real economy at the moment. A lot of those central bank digital currencies, I think, will likely be for transaction basis, whereas we think one of the main attractions of Bitcoin is that it is outside of the remit of any one particular government. So in a world where people are looking for stores of value that are potentially outside of their governmental regime, that Bitcoin potentially is an important, has a differentiated role to play that doesn't come under threat from central bank currencies.
And we've sort of answered this by implication, but I'd like to make it explicit. So Ian Nagel asks, you know, he says, is the Tesla Bitcoin investment? To be clear, we have invested in Bitcoin. Tesla have also put Bitcoin on their balance sheet, I believe, but that's something separate. But you know, is the Bitcoin investment, we'll read it as that, a short-term kind of punt or a long-term belief that Bitcoin will become an accessible and mainstream currency? So there's two elements there. There's currency, which I'm not sure we believe or not. You tell me. And then is this short-term or long-term?
So I think in terms of currency, I think as an alternate to currencies rather than an alternate currency. So excuse my slight semantics of language there. It's people who are looking for it as a store of value in the same way that they would have used gold in the past.
They want to get out of the system.
Exactly, get out of the system and have a store of value in some shape or form. So long-term, short-term, look, clearly when we started getting exposure to Bitcoin, that was in the autumn when the Bitcoin price was $1,500, when there was a huge amount of asymmetry and only limited amounts of institutional adoption. What you've seen over the course of the last 6 months is huge amounts of people come forward with some form of saying this is part of the portfolio. So the asymmetry has probably diminished, which is why we have been reducing the exposure down as it's gone up. So do I think it has a role to play in the portfolios still? Yes. But has it warranted us managing that position down in a way that it doesn't dominate our portfolios unequivocally?
Great, very clear. And I think we've probably got room for one more. And there are two questions quite similar. Julius and Duncan Moore asking them, and it's a common one that certainly I've received, which is, how do you value it? How can you put a value in the absence of any sort of cash flow or link to anything real and productive?
So there are a number of ways that you can mod. There's a very popular supply-driven model that is available on most you can find very easily on the internet. The way that we think about it is in the context of the amount of valuation of Bitcoin versus the total amount of gold accessible gold above ground. So the total market cap of Bitcoin at the moment is around $1 trillion versus total available gold around the world is nearly 13 trillion. And then if you compare it, which I think comes back to where's the threat to Bitcoin, is what's the total market cap outstanding of negative yielding debt in the world, and that's sort of north of $17 trillion now. So in that context, I think we still see there's plenty of blue sky for Bitcoin, but what we will acknowledge is that the valuation of Bitcoin is in large amount based on trust and faith. What is someone else willing to pay for that? But that is also true for the negative yielding debt and gold in the world. So we look at evaluation through the prism of those assets primarily.
Brilliant. Okay, Alex, thank you very much for going into some depth there, and thank you very much for everyone for the very good questions. So, Alex, I think it's time to close down the sort of Bitcoin interlude, and I'll pass back to you for the second half of your presentation.
Great. So having highlighted that we've lived through a uniquely disinflationary regime, which COVID has exposed the fragilities of, and has exacerbated effectively the disparity in wealth in society, we now have a situation where central banks remain determined to reflate the economy. And whilst they currently still operate with inflation targets or price stability targets, what we're seeing is that this inflationary fighting dynamic that Paul Volcker brought into place is effectively being eroded. And if you remember at the outset, I described Paul Volcker essentially coming to the Fed and saying, I will tame inflation, unemployment be damned. You now have policymakers around the world saying, we will return the economy to the position it was prior to COVID, inflation be damned. So we will get maximum employment, even if it means inflation overshooting in the short term, as they say, or even if that inflation is transitory, to use popular Federal Reserve speak at the moment. But clearly you have all of the major central banks of the world, plus the Bank of England, all trying to reflate the economy at the same time. Now, they are also getting huge support from governments around the world. COVID was essentially the crisis that was nobody's fault, which is why, by necessity, you're seeing incomes being replaced and huge stimulus, which is now at wartime levels of stimulus being provided from governments around the world. And increasingly, the lines are being blurred between central bankers and the governments who appoint them. Now, looking back in time, you've seen these levels of deficits have occurred in history, usually at times of war, but just looking at a previous historical example, after the First World War, only 25% of that deficit was made up by tax receipts. The rest was made up by nominal GDP recoveries or inflation. So to get out of this level of government support cannot be done by taxes alone. Now, just to really illustrate the point on the blurring of lines between central banks and government, here you have Janet Yellen. Janet Yellen was chairwoman of the Federal Reserve for a number of years, and she is now US Treasury Secretary. So you have one of the foremost monetary policy thinkers around the world now in charge of the government purse strings. And if that wasn't clear enough as to what her intentions were, this is what she said last year. There is a huge amount of suffering out there. The economy needs the spending. You can't get much more explicit than that. Now, what's unusual is you don't often see central banks and governments acting in concert. What this chart looks at is the level of QE, effectively from the Federal Reserve, and government deficits. And what you can see is that generally, when you've had monetary policy getting looser, you've had austerity. Governments have tightened the purse strings, and they have generally fought each other over the years. Now, COVID, as the crisis that, as I said, was nobody's fault, has elicited an absolute sea change. Not only are we seeing stimulus on a scale never seen before, but you're now seeing stimulus from the two major parts of the economy, both the monetary authorities and the fiscal authorities acting at the same time. And once this happens, it's very easy to continue to see it happen in the future. I was listening to a podcast last week that referenced the first time that Tiger Woods pulled out of a golf tournament. And at the time, people commented that, well, he'll never beat Jack Nicklaus's record now. And the second comment was, well, why is that? Because once you've pulled out of one golf tournament, it's very easy to pull out of the next. And I think this is true about both monetary and fiscal policy. Once they are seen as acting in concert, or effectively having unfunded deficits is the norm, it's far easier to do it again in the future. Now, in the short term, this sort of stimulus could create a serious boom for the economy. Here you hear talk of a modern day roaring 20s, and it's not hard to paint an environment where we have a pretty strong recovery for the second half of this year. Most of us are desperate to get out and spend some money, and a large swathe of people are actually better off than they were 12 months ago because their employment has been subsidized by the government and their ability to spend money has fallen. So if you're going to see economies reopen and the level of stimulus remain, you could be seeing some significant positive GDP surprises through the second half of 2021 and beyond. That potentially sets the scene for an environment that could be really quite exciting for those equities that have really sat in the doldrums for the last regime. Now, if a disinflationary environment that we've operated in has been characterized by an absence of growth, if growth is going to become less scarce, investors won't be willing to pay the premium that they have for the only perceived source of growth in the world. So that could lead to a pretty powerful rotation from growth stocks into more economically sensitive value names. And just to illustrate how far we could potentially go, the violent moves we've seen since November last year are only barely noticeable on the bottom right-hand side of this chart. So it's not all gloom and doom. You could really see a powerful rotation that can drive significant returns for things like energy companies and financials that have frankly been torrid places to be for most of the last 2 decades. Now, having set the scene, and as the poll at the start showed, most of you are cynical about the 60-40 portfolio. The difficulty is that markets never really price a regime change. And this is a representation of a normal distribution. But what it says is the most overpriced outcomes are generally the things that are perceived to have worked most of the time. So here, the outcomes that are seen as most certain, which is a continuation of a disinflationary environment and low fragile growth, is the environment that has supported US treasuries and US growth stocks. Now, to us, that means the tails of this distribution, either a deflationary shock or a more reflationary shock, are potentially massively underpriced in markets. The fact that you still can get very good protection via owning credit default swaps and can still buy a substantial part of the global financial complex at a 50% discount to book value tells us that the market is neither expecting a deflationary shock or an inflationary shock. And that is something that is always the case prior to regime change, in that the market provides opportunities for those who are willing to look beyond the current cycle. Now, back to Paul. As we say, Paul ushered in the last regime. The question that we often hear is, well, they've been pushing pretty hard on monetary policy for a very long time. The fact is, there is a danger that there is too much liquidity in the financial system as a whole. And if we move towards the right tail, which is a more inflationary outcome, that potentially causes a more dangerous environment to investors. And as I said right at the start of the presentation, if we've lived through a uniquely disinflationary environment, one that has been uniquely good for the balanced portfolio, if we are moving from that environment to one with greater uncertainty about inflation and potentially higher inflation, this is an environment that could be uniquely damaging to the balanced portfolio. Now, when does it matter? This is some analysis done by Australian economist Gerard Minack, but what it actually shows is that the environment that we've known for the last 20 years, and with bonds and equities being negatively correlated, is unlikely to persist if inflation rises much above 2.5%. So if inflation is above 2.5% consistently, you should expect bonds and equities to be positively correlated. And the difficulty is that rising inflation probably means that bonds are falling and equity markets are falling at the same time. So positively correlated assets, all of which are falling at the same time, does not bode well for the balanced portfolio. But what do I mean by not well? And this is the Jurassic risk. Are markets prepared for a return to a more inflationary environment? And the common answer is, well, equities will do the job. Well, this actually looks at what your traditional 60-40 portfolio would have done through the previous inflationary regime. The green line looks at nominal returns, and what you can see is your 60-40 portfolio more than halved during a period of rising inflation from 1972 to 1973. But then when adjusted for real terms, you lost nearly 2/3 of your value. Now, to us, and to me, this illustrates potentially the fact that the central pillar to asset allocation for the last 4 decades is potentially hugely under threat from an inflationary environment, and one that the asset management industry as a whole is institutionally unprepared for, because you have to go a very long way back in time to find people who've actually experienced an inflationary regime in markets. So what's the solution? Well, to our mind, something like Bitcoin is part of the solution, as is gold, but we do think the best source of protection in this environment is potentially hiding in plain sight, and that's inflation-linked government bonds. Now, it's no secret that we've held these for many years now, but just to illustrate their potency, what this looks like is the real interest rate. So interest rates after you've adjusted for inflation. If your real interest rate were to move from -2% to -5%, for example, the longest dated inflation-linked bond would go up by a factor of 4 times. Now, this to us, in a world where there is going to be very few hiding places, presents, to our mind, the most attractive protection from the environment that we see as a threat. And in addition to that, the response of policymakers to the crisis has meant that there are some very attractive opportunities to get protection in the more alternative spheres of the world. So this looks at the yield on the lowest rated junk bond in the world. Now, what you can see is that yield is as low as it's ever been. But just to give a bit more detail behind that, the average yield on junk bonds now is around, sorry, on investment grade bonds is just below 4%. Now, the average default rate on investment grade bonds is 4%. So by buying credit today, you're effectively guaranteeing yourself a negative return. Now, to our side minds, this is an absolute mania. And if you can get the other side of that by owning credit default swaps, this is the sort of asset that we think can protect portfolios against a correlated fall in both bonds and equities. And this is actually the asset class that really saved our bacon in March of last year, that when bonds and equities were falling in concert in March, these were assets that are able to help the Ruffer portfolio and Ruffer investors make money. So before I go on to this chart, what I would highlight is we have experienced a uniquely disinflationary environment, and it has generally encompassed the career of everyone operating in the investment industry. Now, this has the potential to make us all think we're a whole lot cleverer than we actually are. We think that COVID has accelerated many of the pre-existing trends that were in place already, whether that's a reversal in globalization or an increased activism from governments to try and stimulate growth. We think this has the potential to usher in a more inflationary regime and a more volatile regime, and one that is probably unfriendly to asset markets. And we think that through the combination of economically sensitive equities, a willingness to own unconventional assets and inflation-linked bonds, these are the sort of things that you're going to need to own to protect clients within the portfolio. And just to wrap up before Q&A, what are the alternatives to a 60-40 portfolio? Well, we would argue you should have a bit of Ruffer in there as well, and I'm sure Toby will tell me off for putting this slide in there as well. But I'll pause there and take questions.
Oh, right, yeah. Thank you, Alex, for that presentation, and of course, Toby too. Before our Q&A session, let's just have a quick recap of those 4 learning objectives at the beginning. Alex and Toby have explained how global governments and central banks responded to the pandemic. They've put this response in its longer-term historical context. Alex identified the key argument for inflation and deflation after the pandemic has subsided. And finally, they have identified and explained how this relates to key asset allocation decisions that advisors will have to make in the coming months and years. Right, we have 10 to 15 minutes available now for the Q&A, so do type your questions in the chat function down there. And as I said earlier, if you prefer your question to remain anonymous, please just select my name from the drop-down list next to where you type your question. I'll kick us off from one from John Orton that he sent in earlier. Alex, do you think the level of national debt will result in increasing levels of inflation, and how will this impact on the gilt and bond markets? I think you may have covered this off a bit already, but
I think it's important to remember the debt itself is deflationary. It constrains people's future spending powers, and it's sort of got us to where we are today. The difficulty is, well, if the chronic problem is too much debt, what are your potential resolutions for it? Now, if you were Austrian, your answer to that would be, well, creative destruction, default on it, and suffer the consequences. I think it's been pretty clear from the government and central bank's actions over the last 2 decades that that's not an option anymore. So they are going to keep pushing the car far harder and harder to try and avoid a deflationary shock. And we think that potentially means that you end up with a more inflationary scenario. And ultimately, let's be clear that that does bring forward a default. It's just a different form of default. If you can reduce the nominal value of debt the real value of debt by having some inflation, ultimately the debts are defaulted on. The difficulty is it's your clients, the asset owners, that pay for that default, because the real value of their portfolios will diminish.
Okay, and we have one from Crispin Homer, who says, markets have risen mostly due to free money in the economy through central bank intervention. How can this stimulus be withdrawn without causing huge market disruption?
I think that's the $1 million question. Well, probably it's probably the $17 trillion question, given the amount of negative yielding debt in the world. And I think that's why you just look at the last week. You had a Federal Reserve meeting where Jerome Powell sort of wiped his brow when he got through the meeting without having made a mistake. And then he's felt the need that he has to give three speeches this week, in addition to his CARES Act testimony, to try and prevent markets from taking fright and bond markets from taking fright. So broadly speaking, it's going to be really difficult and likely to lead to shocks. I think the key aspect is that as you see growth emerging and stimulus withdrawn, it likely is going to lead to steeper yield curves, so rising cost of money at some point in the future. And that is unequivocally going to undermine the valuation of certain asset classes. And what I would argue, and it's something I'm borrowing from a chap called Eric Peters, who made the quote that what policy making has done has brought forward future prosperity to today. Now, that does mean that the future is likely to be a less prosperous place for the asset owner.
And you kind of mentioned through a bit of an add-on to that one. You've mentioned through your presentation that COVID's been a kind of catalyst to longer-term market changes. It's sped up some processes. Is that potentially making everything more volatile as stimulus is withdrawn?
Short answer, Tom, yes, definitely. What are some of those pre-existing things that had been accelerated? If you just have to look at this ongoing spats between the US and China, you were already seeing an economy that was becoming less globalized and more localized. And given that we are now seeing borders actively shut and less free movement of people, you're starting to see that localization be accelerated. And what you're increasingly seeing is, in the different speeds of lockdowns and vaccine rollouts, you're going to get different speeds of reopening. So that is going to make, I think, a much more volatile world, and world that is going at multiple speeds. And I've sort of always had a rule that if you hear a fund manager say decoupling, you should probably switch off. But I do think you're going to see a multi-speed global economy now.
Okay. And Kevin White says, have we all become too short-term focused over the last few years, which is further exacerbated by MiFID II changes, such as the 10% drop reporting rule? And I guess I'd add on to that value assessment for fund, value assessment reports of fund managers as well.
Yeah, I think that's definitely true. And look, the fact is we operate in a benchmark orientated world. So people are not incentivized to take anything other than short-term risks, because they have to beat their benchmark, else they'll be replaced within portfolios or potentially be taking on personal career risk. So I think you do need genuine independence of thought and potentially independence of ownership structures if you are going to take longer term views. Now, I think that does create huge opportunities for those that are willing to look beyond the next quarter's earnings, if you construct that as part of an overall asset allocation.
And how do you guys at Ruffer kind of challenge that temptation to get drawn into a short-term culture? How do you fight that?
I mean, I think we've got a couple of things. The fact that we own ourselves means that we don't have an external shareholder telling us to grow our AUM in any one particular year. So that does align our incentives pretty well. But then I think we do have a very deep, from Jonathan Ruffer, a very deep ingrained understanding of history. And it's not quite Mark Twain, but the observation that we'd make is that whilst the external environment is ever changing, humans' reaction to external environments are always the same. So if you can take long-term views based around that and have a willingness to look back at 12th century oxen prices to give you a hint as to what an inflationary environment looks like, that does embed long-term thinking in the portfolio.
I know you guys kind of addressed Bitcoin earlier, but it's natural that lots of questions will come in because it's a particularly interesting topic. And someone asks, now that Tesla accepts Bitcoin towards the purchase of cars, I think, we've all read about this plenty. Is this the beginning of a new trend for cryptos? Is this making it more mainstream, or is it just Elon Musk being Elon Musk?
I mean, I think there's definitely elements of it being Elon.
Mm-hmm.
I think this is what's more interesting is a couple of things. So last year, the US Treasury officially declared that Bitcoin was not a security, which I think makes it much more of an asset class rather than a tradable security, which we think is quite a big step towards that institutional adoption. I ultimately think that Bitcoin has greater utility as a store of value rather than a transactional currency. I think there are other cryptocurrencies that will fulfill the role of transaction-based tokens. And I think they will have their utilities. It's just not the utility that we want in portfolios at the moment.
Okay, and I'll kind of add on one for myself there. Do you think you would be investing in Bitcoin if Western government bonds were still an attractive place to diversify?
No. Look, the fact is, I think Ruffer has benefited as much as everyone else in this call from the disinflationary environment. And we would love to be in an environment where you could buy a Swiss government bond yielding 4.5% again. But we think the necessity of owning unconventional protections, whether those are options on interest rates, whether that's credit default swaps, whether it's volatility options, or whether it's Bitcoin, is being driven by the external environment. So it is forcing you into more uncomfortable assets by nature.
Okay. I'll kind of shepherd us back away from Bitcoin now. Rowan McKenzie asks, what do you anticipate the effect of the pandemic being on the commercial property market in the short-term recovery phase, and then the longer term as more people work from home as well, and potentially cities attract less business?
So look, I think a combination of infrastructure and commercial property have been a very popular source of diversifiers over the years, and I think that's led to a huge amount of yield compression in these asset classes. I think the difficulty is that if you do move into a much more inflationary environment, you'll start to see rental caps on both commercial and residential property, and I think that potentially reduces upside. But ultimately, these are still asset-backed securities, which I think has some attraction in a more inflationary environment. I think the difficulty is the pricing just isn't attractive because you've had so much money chasing it around. I just don't think that, irrespective of the economics around return to the office, your starting valuations are so high. I just don't think you're being rewarded for the illiquidity premium you're taking.
I think you've probably just answered the question I'm about to ask, but I can't remember quite what your asset allocation was to infrastructure, but is there any Ruffer money in there?
No.
Yeah, I thought you'd answer my question, but thought I'd just clarify. I think we've kind of got through most of the questions now, so I think I'll round us up. Thank you for your questions, and thank you, of course, to Toby and Alex for their really valuable session today. Obviously, before we close up, Toby, would you like to do the draw for those delegates that have asked questions to see who's going to win that case of wine?
Yep, I've got the ball.
I just I've seen one question that I think is really interesting.
Oh, sure. Sorry, go on.
Duncan Moores asked a question about the New Zealand central bank. Now, why is that interesting? New Zealand were one of the first central banks that introduced inflation targeting way back when. What they've done more recently is specifically start to target asset prices in a way to stop bubbles emerging. Now, they're not specifically going to clamp down on property prices, but I think if you think of what we're seeing at the moment as a transition of power away from the management of shareholders of companies back towards government and workers, I think that New Zealand central bank could be a really interesting canary in terms of a different central bank operating model going forward, where they potentially are more concerned with bubbles and containing them than they might have been previously.
Okay,
And
Go
on
for it,
something slightly more light-hearted than trends in central bank policy, which is me drawing a bit of paper out of a bowl. So you can see, I'll look away. We have Crispin Homer. Congratulations. We'll be in touch to get your details to send you the wine.
Brilliant. Thanks, Toby. And of course, congratulations again to Crispin. Before we sign off, let me just remind you of some dates for your diary coming up in April. On the 7th, we're back with our next working lunch, where Abby Chatterjee from Dynamic Planner and Unique Financials Planning, Philip Martin, will debate the question, suitability, sustainability, and risk. Can you do it all? The following week, on 14th of April, we're back with Ruffer again. The title is Regimes Don't Change Very Often, but when they do, it is the only thing that matters. Matt Smith, co-manager of the Ruffer Total Return Fund, will ask, is your portfolio diversified? And finally, at the end of the month, on the 28th and 29th of April, we'll be bringing you our 2-day ESG masterclass, where you'll hear keynote presentations from Next Wealth's Heather Hopkins, Peter Toogood from the Advisor Centre, and 2 experts from FE Fund Info, as well as 6 excellent presentations from Aberdeen Standard Capital, Bailey Gifford, Close Brothers, Goldman Sachs, Pictet, and Royal London. Altogether, that's a tasty 7 hours of CPD and your fill of ESG. That's it for today's session, and all that remains for me to do is to thank Alex and Toby again from Ruffer for their excellent presentation. But let me, of course, reserve the bulk of our thanks to you, our readers, for your company this lunchtime. I trust you found this helpful and worthwhile. If you did, then we'll look forward to seeing you again after Easter. Goodbye.